Welcome to the Weekly Combo Podcast, where I'll go over the action in the market for the week of July 28th through August 1st, and we'll see how things look for the week of August 4th through the 8th. Going through the weekly update, the markets took a hit this week, with the S&P 500 dropping 2.36%, the Dow declining 2.9%, the Nasdaq falling 2.2%, and small caps getting hit the hardest, down 4.2%. Trading volume was above average, a sharp contrast to July's lighter volume when the markets were hitting all-time highs. Early in the week, the S&P 500, Nasdaq 100, and Nasdaq set all-time highs, but the S&P met resistance just a little above the 6,400 level. Later in the week is when stocks turned negative. Several factors drove the downturn. A weaker than expected employment report on Friday, showing just 73,000 jobs created against higher expectations, coupled with downward revisions to prior months, this raised concerns about economic growth. New tariffs on Brazil, Canada, India, and Taiwan fueled worries about corporate margins and global trade. However, earlier in the week, an EU-US trade agreement was reached and was taken as positive. Earnings were mixed. Microsoft and Meta delivered strong results, but disappointing outlooks from Amazon and Apple triggered selling pressure. The Federal Reserve held steady with rates on Wednesday, but soft economic data, particularly the jobs report, boosted expectations for a September rate cut, with now having an over 80% probability of a 25 basis point cut. The 10-year Treasury yield fell to 4.22% by Friday, reflecting a flight to safety. The VIX spiked back above 20, signaling heightened market fear, while defensive sectors including utilities, staples, and healthcare outperformed, while tech and discretionary underperformed. Sentiment dropped sharply. Earlier in the week, it was close to 75. By Friday, it was neutral at 50. And with the S&P 500's PE ratio at a lofty 22, valuations continue to remain stretched. Historically, August is a weak month, up only 40% of the time over the past 5 years, with an average return of a negative 0.5%. Post-election year seasonality suggests potential weakness, which could last through October. Switching over to the intermarket analysis update, despite the pullback later in the week, the broader market remains largely intact. Growth continues to outperform value, and the markets are still overvalued, with the Shiller PE ratio coming in at 38. The S&P 500 is at a forward-looking PE ratio of 21.8. Megacaps are even pricier at 28.4, while mid-caps and small caps, though more reasonably valued, continue to underperform. Foreign inflows, as noted by Bloomberg, are partly driving these high valuations. Growth ETFs and indexes remain in uptrends, while value stocks have fallen below their 50 and 200-day moving averages, signaling relative weakness. Inflation indicators such as the CRB index are leveling off, and Treasury inflation-protected security ratios are declining, suggesting easing inflation concerns. Commodities including aluminum, corn, and wheat continue to be in downtrends, though lumber and fertilizer hit at potential inflationary pressure. Copper took a significant hit this week, dropping 23.65% due to tariff news. But it remains in a longer-term uptrend as an economic barometer. Gold continues to hold steady. Silver slightly outperformed this week, and the US dollar index, after seeing a bounce above 100, settled in the 98 range. Bonds rallied on Friday as yields fell, reflecting a flight to safety. Tech and utilities led sector performance, with utilities potentially benefiting from AI and EV-driven electricity demand. The financials and energy, however, lagged, with the financials dropping below key moving averages when compared to the S&P 500. Most markets, including stocks, tech, and bonds, remain in uptrends. August seasonal weakness, combined with copper's decline and financials underperformance, calls for caution, but no major trend reversals are evident yet. Moving over to the deep dive update. Friday's decline flipped the short-term trend bearish, with the S&P 500 falling below its 20-day moving average. However, the market remains above anchored moving averages going back to 2022, 2023, and the April 2025 lows, with potential support if we drop to 5,800. The intermediate-term trend is still positive as the S&P 500 holds above its 50-day moving average. Small caps continue to underperform large caps, pushing the large cap to small cap ratio higher. Advanced decline lines for the S&P and NYSE are pulling back, with the NYSE dropping below its 50-period moving average, hinting at weakness. The short-term advanced decline ratios and momentum indicators, including the McClellan oscillator, have turned negative, showing divergences as the market was making higher highs previously. Bonds rallied with yields dropping as the 10-year to 3-month yield curve is yet again inverted, a potential recessionary signal if it persists. Gold rose on Friday as a safe haven, with global markets, including the German DAX, weakening below its 50-day moving average. The long-term VIX outlook remains positive, with its 50-day period exponential moving average declining, but the Ulster Index ticked up, reflecting Friday's surprise decline. August and September are historically negative, so we'll monitor key support levels to see if they hold or if declines deepen. Moving over to the What to Watch update. The key question is whether the S&P 500's pullback is temporary or the start of a major decline. Positive signals include the S&P 500's uptrend, holding above its 30-period exponential moving average, but below its 20-period moving averages, and near pivot point support. The intermediate-term trend remains positive, with the 50-period moving average intact so far. Growth-to-value ratios across large, mid, and small caps are still in uptrends, and the tech-to-staples ratios favor tech. Stock-to-bond ratios suggest the markets expect a soft landing, and indexes including the Nasdaq, Dow, and semiconductors remain positive despite Friday's pullback. On the negative side, the S&P 500, as stated before, is below its 20-period moving average, and short-term indicators including the advanced decline oscillator and TTM squeeze are bearish. The smart money indicators, including accumulation distribution, Chaikin money flow, and Chaikin oscillator, are all negative. Negative divergences seen as the market was going up include the McClellan oscillator and summation index, suggest that momentum had been fading, and long-term sell signals, including the NYSE Zahorchak method, continue to flash. Key areas to watch include employment data, with unemployment now at 4.2%, and any tariff impacts weighing on sentiment. Bond yields, particularly the 10-year dropping significantly, and the inverted yield curve raise recession risks. Sector ratios, including discretionary to staples and tech to utilities, are weakening, and bellwether sectors, including semiconductors, transports, and regional banks, are also faltering. Commodities, including oil, being in the mid-60s, while there's a stable gold to SPY ratio. And the dollar's quick drop down into the 98 range adds another layer to monitor. I hope you found this podcast helpful. For more in-depth analysis and commentary, the full-length daily video update is available on YouTube and Rumble right when the market closes each day. To access the videos immediately after they are available, or to access the daily newsletter, please click on the links below.